Good day, everyone. So today is our sixth week for the second quarter lesson for the subject Business Finance. And now, our lesson for today is all about personal finance. So by the way, this subject or this topic will be our last lesson for the second quarter or the first semester. All right, so before we proceed with our lesson, let me first read to you the objectives. So at the end of this chapter, the students should be able to A. Define personal finance. B. Explain the personal finance process. And letter C. Discuss personal savings, spending, and investing principles. So what are those concepts of personal finance? So, personal finance. So this refers to the management of financial activities of a person, which include the first one, we have the proper allocation of personal resources, budgeting of household expenditures. Third, we have the savings and insurance for retirement, and of course, the personal investing and financing activities. So, for the personal finance process, the personal financial planning process usually involve the following stages. So, the first stage is we have the conducting personal financial assessment. And then the second one is we have the setting goals and objectives. Third is the preparing a financial plan or budget and then executing financial activities. And of course, the last one, monitoring and evaluation. And also we have the conduct personal financial assessment. So in financial assessment, whether corporate or individual, it is the starting point of all financial planning processes. So this step is a must both in business operation and personal life. So the basic questions that must be addressed during this stage are how much do I personally have, and of course how much are my income and expenses. So the basic rule in making a balance sheet and income statement is honesty. So the data must reflect the real financial situation and status of a person. So we have here illustration 1 of the personal balance sheet for the Yvonne Salcedo. So as we have seen on the picture, we have their assets. So under the assets, we have the current assets, of course, and the fixed assets. And then for liabilities and capital, we have the current liabilities and then the long-term liabilities. Next is we have also for the income statement, illustration 2, wherein we only have finance. So under the assets. So under the assets, we also have the source of personal revenue, personal and living expenses, and then of course the personal net income. So this is the difference between the personal balance sheet and of course the personal income statement. So next is the set goals and objectives. So goals and objectives have similarities or common characteristics. So both deal with future events with some degree of uncertainty. So however, the two seems differ in terms of scope and time frame. So on the personal financial goals, these are broad and usually long-term in nature, covering a period of more than 3 years. So examples of financial goals, we have first one to retire at age of 60 with retirement savings of 2 million pesos, to buy a residential house and lot amounting to 3 million pesos at the age of 45, and then to acquire security investments of 5 million pesos at the age of 50, and of course to accumulate a personal net worth of 10 million pesos at the age of 65. So that's for the personal financial goals. And now for the personal financial objectives, these are specific requirements or the directions with a time frame of 1 year or less. So for the personal financial goals is a long term. So for the personal financial objectives, this is just for a time frame of 1 year or less. So the gradual achievement or fulfillment of financial objectives leads towards the realization of the personal financial goals. So examples of financial objectives is we have to settle totally outstanding obligations to creditors amounting to 175 pesos, to save the amount of 45,000 pesos every month, to buy 2 desktop computers next month costing 75,000 pesos, to increase the monthly income by 15,000 pesos every month, and to borrow a short-term loan of 80,000 pesos from a partner bank. And so in setting the personal financial goals and objectives, the SMART principles should be followed. So the SMART principle is what we have: the specific, the measurable, the attainable, realistic, and time bound. Next is, how are we going to prepare a financial plan or budget? So when you say budget, it is the financial goals or objectives expressed in terms of peso. So it is an estimate of what will happen financially in the future based on the events that have happened in the past. So we have two major steps that are followed in the preparation of the personal budget. So the first major step is we have the preparation of the estimated income, and the second one is the preparation of the estimated expenses. So for the preparation of the budget, it starts by estimating the income for the year. So this amount serves as the threshold amount of budgeted personal expenses. After the preparation of the estimated income for the year, the monthly personal budget for expenses is made. So the total expenses incurred in the preceding month or year may be used to determine the estimated itemized personal expenses and adjusted according to inflation rate. So the estimated expenses will be based on the financial activities for the following month. So here we have illustration of the monthly financial budget. So as you can see, we have there the estimated personal income, and of course the personal and living expenses, and then the estimated income or savings during the month. So under the estimated personal income, we have the salary for January and then productive fee. And then under the personal and living expenses, of course, we have the food budget, the clothing, and many more, of course. And so next is we have the execute financial activities. So the next step in the process is what we call the execution of various financial activities. So the day-to-day activities should be carried out in accordance with the financial budget, and then the amount stated in the financial budget may sometimes serve as a threshold or a particular expense account. So it is strongly suggested that financial activities follow the financial budget. So spending beyond what is planned will definitely lead to financial problems. So it is not a healthy financial practice. So at this point, the documentary evidence on purchases, expenses, and other financial activities should be kept intact and recorded properly for future reference and monitoring. So for perform monitoring and evaluation, that this is the last step in personal financial planning. So the monitoring of financial activities entails regular checking and comparison of the actual expenses against the budget. So if necessary, remedial financial measures are adopted immediately to address irregular incurrence of expenses. So the evaluation of the financial activities happens at the end of the month. So it is necessary to conduct variance analysis between the budgeted amount and actual expenses. So expenses beyond the budget or income below the target are considered in favorable variance. So on the other hand, the actual expenses that are lower than the budgeted figures, as well as as income that is higher than the estimated amount, are indicators of favorable outcomes. We have here the monthly income statement evaluation. So under the monthly income statement evaluation, of course, we will see the actual, the budget and the variance. So the actual income may serve as the basis in preparing the budgeted income statement for the succeeding month. Based on the evaluation, the amounts comprising the income statement may be adjusted to conform to the expected financial requirements of the following month. So next we have the major personal financial activities. So the financial activities of a person or family are broadly categorized as follows. So the first one is we have the savings. Second one is the spending. And then the third is we have the investing. So for the personal saving principles, saving money for the future is a must for everyone to avoid financial difficulties or hard times. So though money cannot give absolute happiness, it is necessary to save to survive in a consumer-driven economy. So when you say personal savings, this refers to the amount of money set aside by a person or family for future financial requirements. So in economics, personal saving refers to the excess of current disposal or disposable income over personal expenditures. So we have here the following principles on savings are on personal savings are handy guides in handling savings activities. So the first one, we have to save 10% to 20% of your income, include savings in your budget, put your money in a stable banking situation, never announce or let anyone know of your savings. Once money has been deposited as savings, never count it anymore. Do not put your savings in only one bank. Deposit regularly or make deposit as mandate. Start saving now, not tomorrow. Check the interest rates and compounding periods of financial institutions and monitor the deposits regularly. So that is for the principles on personal savings. So next is what we have, the personal spending principles. So spending is not a bad financial activity. It provides people with what they need. So every individual or family spends money for food, clothing, medicine, and even for the education of children. However, to work for the benefit of the person or family, the act of spending should be guided by these principles. The first one is spend within the budget. Spending should be within your capacity to spend. Discipline your spending behavior. Record properly your monthly spending. Pay your bills on time. Avoid penalties in your financial obligations. Finds ways to spend wisely without sacrificing yourself or the family. Compare the present value when purchasing items on their cash or installment basis. Always buy goods with lower price but of good quality. And the last one, do not borrow money when it is not necessary or if you do not have the capacity to pay. Next is, or the last one we have, the personal investing principles. So when you say investing, it is very similar to savings. However, savings is primarily concerned with supplying the cash requirements for future needs, while investing, on the other hand, is intended to generate more inflow or income or cash. Investing increases the net worth of a person. So the following principles may be observed in investing. So we have the first one, invest in legitimate investing activities. Do not put all your funds in one type of investment. Always compute the market price of bonds and stocks before investing. In case of securities investment, always monitor the interest rates of the BSP. Always compute the present value of the invested or the investment based on expected cash flow. Check the insurance policies before buying. Invest more on properties that appreciate. Invest on securities using the rate of return and the risk involved as basis of evaluation. Compare the nominal and effective interest rates of securities and of course invest specifically for retirement. So that could be all for our lesson, and this is our last topic for the second quarter. So I hope you have learned something, and that could be all. Thank you.